Hello friends and colleagues, my name is succesfull and you probably know me as arbitrage trader from Seeking Alpha. The video you're about to see will go through some of the arbitrage strategies we use. Before launching our service, we want to make sure that our readers are more familiar with what we do. Please excuse my accent and let's start. The motto of today's video is that arbitrage exists. It is not exactly risk-free as many of the readers expect, but more of a probability game with the odds in our favor. The simplest strategy we use is preferred stocks versus preferred stock. Here the mathematics is really simple. We are looking for two preferred stocks that are almost identical and have a recent deviation in valuation. The best case scenario is with preferred stocks from the same company, as in one of our articles about customary preferreds. The article was written on the 4th of October 2016, and at the time the two securities were trading at only 30 cents spread. This resulted in a current yield spread of more than 1%. As the two stocks were trading below par, their current yield was their yield to worst, and the reasonable investor would expect them to trade at equal current yields. After a fast check in their prospectuses, we were sure that the fundamental arbitrage was in place, so the next step for us was to run the pair through our software to determine if statistics approve the pair trade. On this graph, you see how well the stocks correlate and how they deviate from time to time. In this exact moment, the deviation was quite significant and arbitrage action had to be taken. This is done by going long CMRE preferred G and short CMRE preferred B with the expectation for the stocks to mean revert while narrowing their current yield spread. This particular trade acted fast, which is not usual at all for such low volume instruments. Don't get the wrong impression that it is that easy. These trades come with a lot of difficulties along the way. The overvalued stock may be hard to borrow, or the borrow cost might be very high, or there might be some buyer who will hold the inefficiency forever. The pair trade needs trading skills for sure, but the income investor is the one who has nothing to lose by switching from the lower yielding one to the higher yielding preferred stock. The idea in our income portfolio is to always switch to the better alternative. This way we'll be able to boost returns by capitalizing on market inefficiencies. Simple and working. The next strategy we want to concentrate on is a very similar one, bond versus preferred stock. Imagine that you have a bond that is yielding more than a preferred stock from the same company. This has to be a straightforward arbitrage trade. Bonds are senior to preferred stock, and on top of that, they usually have a maturity date which most preferreds don't. The only disadvantage to bonds is that they pay interest and their distributions are never qualified for preferential tax treatment. Sometimes the market treats bonds unfairly compared to preferred stocks and forgets about their seniority. One such case can be found in one of our articles written on 11th of December 2015. At the time, SSWN, a baby bond of C-SPAN Corporation, had a very heavy seller that brought its yield to maturity to more than 10%. Maturity was in 3.5 years at the time. The current yield of the preferred stocks was around 8.5%. There was no financial logic to justify this yield spread between a bond and a preferred stock. The market soon reacted. There was a time when the pair trade SSWN long versus SSWE, one of the preferred stocks taken short, was more than $5 in the money. This is a very large deviation in these instruments. Currently, as the maturity date of SSWN is approaching and SSW is having a lot of issues, the bond is trading again 3 points higher than the preferreds. This is one of the perfect examples of market inefficiency. The conclusion from this trade is to always take a look at where the bonds are trading if you are going to invest into preferred stocks. We're constantly screening for situations like this and have a lot of success in trading them. But lately, the market is not presenting us with a lot of opportunities like this. Another simple strategy we are constantly screening for is in closed-end funds. They do deviate around their net asset value. For most of the funds, it is reasonable to expect that they will mean or mode revert. If we are able to find a good benchmark that correlates with the net asset value of the fund and we detect a decent deviation, we are ready to act. One such example is the fund HYT. The article about it was written on November 2016, and at the time the fund traded at minus 13.5% discount to NAV. As an absolute number, this is just a large discount, but the point here is that this was the first time in 1000 trading days that the fund traded at such a large discount. We could not find any reason behind this, and had every reason to believe that we will see a mode reversion here. The technical seller was fastly taken out, and the fund started trading at its normal discount levels. This strategy is suitable for the long-term investor who is ready to take the time and learn when to switch between overvalued and undervalued funds. For the pair trader, it is also a suitable strategy as long as you can find a nice substitute to the net asset value. The deviation in this strategy is between the fund and the net asset value, and you cannot trade the net asset value of the fund, so you have to search for a substitute. We have found the best substitutes for almost all of the closed-end funds that trade on the US exchanges. And we initiate pair trades between them as 1 to 3. In the case of HYT, you can use ETFs such as HYG or PHB. They're a perfect match to the net asset value of the fund as seen on the picture here. Once you have 99% correlation and a regression model with such a small deviation, you are 99% sure that you have found a nice substitute to the net asset value. By taking a short position in HYG, for example, you're actually taking a short position in the net asset value of the closed-end fund. It's very simple but needs a lot of preparation. The next simple strategy we use is when we have two almost identical closed-end funds that have deviated without any fundamental reason. Take a look at this picture. These are the net asset values of PMF and PZC, two PIMCO closed-end funds for the last 800 days. They have a correlation of 100%. You cannot find products more identical than this. They are even more identical than twin preferred stocks. But as we have described in our articles, the market somehow was not understanding that the two funds are one and the same thing. These are the same two funds, but this time we're comparing not their net asset values, but their prices. There was a large deviation because PMF cut its dividend several months before PZC did. A reasonable investor and a reasonable market would expect the same to happen to PZC, and the expectation had to prevent the two funds' prices deviation, but it did not. So we were there to act. You're probably surprised how simple this strategy is, but have a look at what happened. On 3rd of July 2017, the distribution cut was announced for PZC, and the whole 20% deviation is almost gone in 2 trading days. Unbelievable, but simple and working. We have to screen for such trades, and we constantly do. These 4 strategies we consider to be the simple and straightforward ones that bring almost no fundamental risk. The next 3 strategies we want to discuss are not so simple and do carry some directional risk. On top of that, they occur in highly speculative companies that are facing direct risk of bankruptcy. The basic idea in these strategies is that the general public views any single company mainly through its common stock, and very often the market forgets that there are instruments with higher seniority that need more attention than the common stock. The simplest of the 2 strategies is traditional convertible preferred stock versus its common stock. The convertible stock has value as a convertible and value as a preferred stock. It always trades higher than its conversion value, and it acts as a support level that cannot be broken because the market participants will be able to make risk-free arbitrage by going long the preferred and short the common stock. The interesting in this strategy is not the conversion value, but how the market treats the value of the stock as a preferred stock. The more the company is distressed, the more this value will go closer to 0. But if the common stock, a distressed common stock, rallies, this means that there is something positive for the company, and this value has to appreciate. This puts the convertible preferred stock in a better position than the common stock in a bullish scenario, because once its conversion value makes it appreciate, and the value as a preferred stock also has to appreciate because something positive has happened to the company. If this value fails to appreciate after a sharp rally in the common stock, this provides a hard-to-understand arbitrage opportunity. Choosing the appropriate hedge ratios for this strategy is also hard, but we have success of doing this. Here is an example from one of our most successful trades based on this strategy. The date was 12th of April 2016 and CHKDG, an over-the-counter convertible preferred stock of Chesapeake Energy Corporation with par value of $100, was trading at $21.31, while the common stock CHK has just rallied 400% of its lows to trade at $6. CHKDG appreciated accordingly based only on its conversion ratio. Such a sharp rally of the common stock would definitely mean that bankruptcy fears were 100% behind, and still the preferred value of CHKDG was absolutely uncomparable to the market capitalization of the common stock at the time. The suspended cumulative dividend was valued by the market at only $4.56. If the company was to survive in the next 5 years, then this dividend had to be reinstated, and by doing some basic financial calculations, there was no chance for CHK to outperform CHKDG in terms of internal rate of return. The arbitrage opportunity was present, and the only thing left to determine was how to scale the trade. We wanted to make money in both scenarios, bullish and bankruptcy. So we went with a position of 550 shares short of CHK common stock versus 100 shares long of CHKDG. In the example on the right, you can see how the trade went, but we're using CHKDG as a substitute to CHKDG because we do not have historical data for the over-the-counter preferred stock. This makes our results a little worse here on the pictures because at the time CHK preferred G was overvalued compared to CHK DG. But still the trade is valid. In a bankruptcy, we would also make some money. But what happened is something we did not expect, and we could not hold our positions till the end. The market very soon realized his mistake in valuing the convertible preferred stock, and the preferred stock deviated from the common stock based on the appreciation of its value as a preferred stock. This resulted in more than 30% profit on the holdover amount of the position long plus short in a very short time. On the chart here, you can see how the convertible preferred stock crushed the common stock on the way to recovery, a very rare occasion and not so straightforward arbitrage to execute, but we are prepared even for such kind of opportunities, and we will come up with a model. Just give us volatility. The next example of our strategies is very similar, but here we have a distressed company and its preferred stocks. There is no conversion value to deal with, even though distressed companies often try to exchange preferred stocks for common stocks, which makes any distressed preferred stock a potential convertible one. In the example from our article written on March 15, 2016, you can see how the ratio of market capitalization common stock divided by market capitalization preferred stocks went to extreme highs for the company Nevios Maritime, NM. This was happening as the preferred stocks were trading at $3.79 or less than 20% of par value. If your preferred stock is trading at these depressed levels, this means that your company is in a serious trouble. Any reasonable investor would expect in times like this the ratio in question to decrease, not to increase, because the preferred stocks are senior to the common stocks. Based on a simple mathematical model, we construct the relation between the common stock price and the preferred stock price at the expected level of this ratio. In the case of NM, we expected this ratio to come down to its lows. The pair trade was $380 long in the preferred for every $740 short in the common stock. This way, we made sure that we will make the same profit in all scenarios as long as the ratio returned to its lows. How were we sure that the ratio will return to its lows? Well, this is the case with almost all distressed companies we have seen. On top of that, we were ready with a reaction to buy more and more preferred stocks if the rally in NM common stock continued. The mispricing for us was quite obvious because we have been trading this a lot. I am pretty sure that my group has not missed a single mispricing like this in the last 3 years. On the charts here, you can see what happened next. Currently, the preferred stock is trading almost 5 times higher than it used to compared to the date the article was written, and the common stock is trading even lower than the time the article was written. Of course, our target was not that high, but what a trade it was. We continue with almost the same example, but this time we go one step higher in the capital structure, bond versus common stock. The idea is absolutely identical as with the preferred stock, but we have the extra protection from going long a bond, which has even stronger covenants. The trade here was taken on the 3rd of March 2016, and the bonds of Vanguard Natural Resources were trading at 10% of par value, while the common stock was still paying a dividend. The situation was so ridiculous that I could not believe this is possible. This is in fact one of the biggest arbitrages I have seen in my trading career that was not a short squeeze manipulation. Currently, the company is in bankruptcy and the bonds are trading very close to zero, so probably the market was right at the time that the bonds were almost worthless. But I still cannot understand how the common stock was trading so high. This trade went to unbelievable returns. The bond rallied more than 500% while the common stock lost almost all of its value in that time. A very patient pair trader could make a fortune out of this one. My initial target was 100%, and what happened continues to amaze me. The strangest thing was that some market professionals were not understanding how great this trade was. The comment you see is from this article. ARP. Really, is this the best way you could find to make money in these markets? Like this silly mess? The trade long the bonds versus short the common stock VNR? Wow, we should look for a way to short you. Probably a better trade. No offense, Heidi and the girls. The market is full of people who don't understand it, and we will constantly try to make money out of them. I see nothing wrong about it and hope to have you in my chat room. Thank you very much for watching this video till the end, and I want to finish with one of my favorite quotes. The greatest enemy of knowledge is not ignorance, it is the illusion of knowledge.